Hello everybody, this is Toni Turner and welcome to the market now as of about 1 p.m. Eastern on Friday, November 2nd. Well, U.S. job growth rebounded sharply in October and wages recorded their largest annual gain in 9.5 years, pointing to further labor market tightening that could encourage the Federal Reserve to raise interest rates again in December. The Labor Department's monthly employment report today also showed the unemployment rate steady at a 49-year low of 3.7% as over 700,000 people entered the labor force in a sign of confidence in the jobs market. And on that note, let's move on to 3 charts that could give us some insight into the week to come. As we usually do, our first chart is a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our S&P 500 index, and we use it because we can see volume on it, which is important to me. Of course, you can't trade an index. You can only trade a derivative of it, which this is, so you can't see volume on the S&P index itself on the chart of it. So, as we know, the SPY has sold off dramatically since that lower low in October. It fell, the SPY fell recently all the way down in this past month. It fell down to right here, you can see it, $259.85 or $25.98 on the S&P 500 itself. That happened on October 29th, and it fell to a low that was 10% below the all-time closing high. And that means that the SPY, S&P 500, fell to correction territory. When we talk about correction territory, that's always 10% below the all-time high or recent high action, and that was done. We got into correction territory. Fortunately, we didn't stay there. The SPY rallied off this point down here at about 259 or so, and yeah, 259.85, and it rallied back up. Now the SPY, when I captured this chart, it was trading at $270.75, or about 2707 on the S&P 500 itself. Now we're back up here. We're only 8% below the all-time highs, so we're out of correction territory. That's good. Now we can see here that the SPY gapped up last Wednesday. Here we have Wednesday, Thursday, Friday. So it gapped up when it rallied, and that's certainly a sign of short covering, but also buying as well. Now we've reversed that today and started back down, but we'll see here, can price hold above 270 or 2700 on the S&P 500? If not, we have price support down here right about 261, 262, and we can see that that also came in back in April of this year, and early into May we also had that same number here that acted as support. So the question now is, can we hold here at 261, 262? Now, if we can't, next support level down is about 257, 258. We have another week of major earnings announcements. Of course, this coming Tuesday is election day, which may have an effect on the market. We still have tariffs and geopolitics remaining a concern. So we're not out of the woods here yet. As far as volatility goes, and volatility means wide price swings, as long as this market keeps making these huge up and down intraday moves from moving real high down from positive territory down to negative territory. As long as this price action keeps up, as long as the market, the buyers and sellers are duking it out, we are going to have this volatility. And we'll have to see in the coming weeks if the SPY can actually hopefully hold above this 261 line here. Above 270 would be nicer, but I don't know about that. We'll have to see if the SPY can hold above 261, this zone here, maybe even start mellowing out and forming a base. Now, if you can see back into March of this year and look back yourself, it's not on this chart, January, February, we had a lot of volatility, as you may remember. Then it finally simmered down, and in April you could see how price action simmered down some more. Not quite as many great big volatile wide price swings, and it gradually simmered down, calmed down, and then we had this wonderful uptrend that you see here from June, July, and August. So can we pull that off again? Maybe, but I believe we've got still another couple of weeks here at least of price volatility as the market decides which way it's going to head as we move into actually the 3 best trading months, most profitable months of the year are November, December, and January. So that's good news. I will keep an eye on the SPY in the coming week and in the coming weeks to see if it does calm down here. If it can build a strong base and start up, then in the meantime, if I see opportunities that look like they have legs, I'm going to enter only with small positions and firm stops because I don't particularly want to get whipsawed in this market environment. Remember, cash is a position, and staying on the sidelines until things smooth out is not always a bad idea. Now let's move on to our daily chart of the PowerShares QQQ. As you all know, the QQQ represents our important NASDAQ index, the NASDAQ 100. That's the top non-financial stocks in the NASDAQ stock market. Now we know that QQQ made an all-time closing high on August 29th back here at $186.74. Then it made this didn't go up quite as high, kind of fell down here very, very slightly in the first part of October, and then along with the SPY fell pretty darn dramatically for the remainder of that month. The QQQ made a current low on October 29th at $160.09. Now it rallied from there just like the SPY did, and when I captured this chart today, the QQQ was trading at $169.15. As you can see, it fell today. A lot of that moved down. Apple's earnings came out last night, and the bears took over Apple today. They are not happy with that particular camper. So at least for today anyway, Apple has a lot to do with dragging the QQQ lower. And it has a little bit, of course, also to do with dragging the SPY lower, as it's a major component of these indexes. So again, the Qs gapped down this morning, a lot of it on Apple's announcements. We'll see now if the QQQ can hold price support here right about 168. There is prior price support here at 168. If it can't hold that, then in the coming week, we may see the Qs fall lower to some point. We're hoping that that the Qs stay above $161. This blue horizontal line you see is price support at about $161. If not, we have more support at 157 from April, 157 from right about here, and then down to 154 also in the month of April. And I won't draw that all for you, but it comes in here and it comes in up here. So we'll have to see. All along here there's price support. Hopefully we don't see the Qs fall below that, because that would mean we'd have to get a whole lot more conservative with our trades. So keep an eye on the Qs and the SPY in coming weeks. And again, please don't be afraid to stand on the sidelines if that works for you. We don't want to take unnecessary losses in this market. I certainly don't. Our final chart today is the iShares Medical Devices ETF, the IHI. It has 59 holdings, including Abbott Labs, Medtronic, Thermo Fisher Scientific, Danaher, and Becton Dickinson. We had here on the IHI, we had an all-time closing high of $227.72 on October 1st. Now, it certainly did sell off with the rest of the market. That makes sense. The IHI has been an absolutely delightful uptrend since April, walking up its 50-day moving average, then getting a little too far overbought here. You can see on the RSI how the IHI really got a little too far out over its skis here. Remember that price corrects through price and time, price and or time, meaning it either moves sideways or it moves lower. And time means when it's moving sideways. We have a little bit of both here. But the IHI needed to correct a little bit. Suspect that valuations were getting pretty high. Recently, it came down to the 200-day moving average and $200 coincidentally. And it's fallen 12% from these all-time highs. It's all the way down, rally a little bit, all the way down, and now sitting above its 200-day moving average, which again, coincidentally, is coming in at $200.65. Now, when I captured this chart today, the IHI was trading at $207.94. Of course, we know that that healthcare tends to be a defensive place for people, for investors to go to when things get rocky. I went through a lot of charts today before I chose this one. Most sector ETFs are trading way below their 200-day moving average, and in patterns that I don't really care for quite yet. The IHI has remained reasonably orderly in the face of the market downturn. I like that part about it. It's always been a reasonably orderly ETF, and that's certainly easier to deal with than disorderly. So I'm going to watch the IHI into the coming week. If it can stay above the 200-day moving average, again at about $200, in the coming week, if it looks like it can stay above it and remain positive, I may add some shares to my portfolio. It will be a limited amount. Again, I don't feel like getting whipsawed in this market. And if the IHI falls to close below the 200-day moving average, I will exit my position. Because it's price support here as well as moving average support, so I'm not interested in getting hammered by shorts. But if it can stay above this line, if it can build a base here and perhaps start moving sideways and then start rallying higher in November, I think it'll be a good trade. And if that happens, I will probably add to my position. And of course, by then I've established a trailing stop. So you may want to keep an eye on the IHI in the coming weeks. And now for the next week's economic reports. But first, I want to alert you to an exciting opportunity. This is a perfect time to check out my online training, How to Bottom Fish Like a Pro. We are offering this training right now at a 20% discount. And I say this is the perfect time because the October sell-off in the market has beaten down a flurry of really high-quality stocks that are now ripe for the picking. With this training, you will discover quickly and easily how to spot the stocks that have sold off and are ready to reverse higher and potentially giving you profits of 20, 30, 40% or more. Plus, many of you will be able to pay for this low-price training with your first trade. So check out this offer by clicking the button below or go to the link you see on your screen. For the coming week's economic reports, please remember we are still in third quarter earnings season and many, many more companies are announcing their earnings. As well as that, we have economic reports, not too many this week, but important ones. On Monday, we have ISM Services. On Tuesday, we have Consumer Confidence and the Case-Shiller Real Estate Index. On Wednesday, we have our usual weekly crude inventories that come out at about 10:30 p.m. That will be highly watched. On Thursday, we have our usual jobless claims and natural gas inventories, and we have this month's FOMC rate decision on Thursday afternoon. On Friday, we'll have the Producer Price Index. Again, you'll want to check out How to Bottom Fish Like a Pro. Our special 20% discount is available just for a few more days. Learn how to buy low and sell high. It's a simple and effective approach to the market that can make your trades more profitable from now on. Until next time, keep green on your screen. I'm Toni Turner, and this is the Market Now.